Walk into almost any bank and ask a simple question. Where does the money for my loan come from? Most people already believe they know the answer. Another customer's savings. Money sitting quietly inside a vault, waiting to be borrowed. It sounds logical. It sounds responsible. It is also one of the biggest misunderstandings in modern economics. Because commercial banks rarely lend existing money. Most of the time, they create entirely new money. Not by printing cash, not by discovering hidden wealth, but by writing numbers into existence. With a single approved loan, new purchasing power enters the economy. New deposits appear. New money begins circulating. Nothing physical needed to move. Nothing needed to leave someone else's account. Most people believe banks are warehouses for money. Architects know banks are factories. Factories producing something far more valuable than paper: credit. And in the modern economy, credit becomes money. Today, we decode how banks create money, why loans expand the money supply, and why understanding this invisible factory is essential for anyone who wants to understand wealth, inflation, and the architecture of modern capitalism.
For centuries, banks were viewed as vaults. People deposited gold. The bank stored it safely. Someone else borrowed that same gold. The system was relatively simple. That historical memory still shapes how millions of people think today. Most imagine banks operating like giant warehouses. Deposits come in, loans go out. Money simply changes hands. But modern banking no longer operates that way. Today's commercial banks perform a far more extraordinary function. They do not simply transfer money, they expand the money supply itself. Imagine walking into a bank, requesting a business loan. Your application is approved. The bank does not open a secret vault. It does not search for another customer's cash. Instead, it creates a new deposit in your account. At that very moment, new money enters the economy. No printing press, no armored truck, no stocks of newly printed banknotes, just a digital accounting entry. That single moment changes everything, because the loan did not merely finance your business. It expanded the total amount of money circulating inside the financial system. Most people think money moves. Architects know modern money is constantly being created, and every new loan quietly expands the invisible architecture beneath the global economy. To understand modern banking, we must stop thinking about cash and start thinking about balance sheets. Every commercial bank operates on one simple principle. Every asset must be matched by a liability. Every transaction changes both sides of the balance sheet. Imagine a business owner applying for a $1 million loan. The loan is approved. What happens next surprises almost everyone. The bank does not search for $1 million inside its vault. It does not transfer another customer's savings. Instead, the bank records a new asset, the loan contract. At exactly the same moment, it records a new liability, a $1 million deposit inside the customer's account. Notice what just happened. The loan created the deposit. The deposit did not create the loan. A brand new financial asset now exists. A brand new bank deposit now exists, and the total money supply has expanded. Nothing was taken from another customer. Nothing physically moved. The money simply did not exist until the bank approved the credit. This is why economists often say loans create deposits, not the other way around. That sentence sounds simple, yet it completely transforms how we understand money. Most people believe deposits allow banks to lend. Architects know lending creates new deposits. Deposits certainly matter. Banks need funding, liquidity, capital,
and regulatory reserves, but operationally, the act of lending itself expands the money supply. Think of an architect designing a city. The blueprint comes first, the buildings appear afterward. Modern banking follows a similar sequence. Credit comes first, money follows. Because in today's financial system, credit is the mechanism through which new purchasing power enters the economy. Every mortgage, every business loan, every commercial loan, every line of credit quietly expands the network of money circulating through society. This explains why periods of rapid lending often coincide with economic expansion. Businesses hire, consumers spend, construction accelerates, investment increases, new purchasing power supports new economic activity. But every system has another side. If loans create money, what happens when loans disappear? What happens when businesses stop borrowing? What happens when households reduce debt? What happens when banks become afraid to lend? Those questions reveal the next hidden layer of the monetary system, because if credit creates money, then the destruction of credit can make money disappear just as quietly.
If banks create money by issuing loans, then an even more important question emerges. Can money disappear? The answer is yes, and it happens every single day. Imagine you borrow $1 million to expand your business. The bank creates a $1 million deposit. The money enters circulation. Employees receive salaries. Suppliers receive payments. Equipment is purchased. The economy grows. Years later, your business succeeds. You repay the loan in full. Most people imagine the bank becomes richer. Architects know something very different happens. The moment the principal is repaid, the money originally created by the loan ceases to exist. It disappears from the banking system, not because someone stole it, not because it was physically destroyed, but because the accounting relationship that created it no longer exists. The loan disappears, the deposit disappears, the newly created money disappears with it. Notice something extraordinary. Modern money is constantly being born and constantly disappearing. The money supply is not a fixed quantity. It breathes, expanding, contracting, expanding again, like the circulation of blood inside a living organism. This is why credit is often called the lifeblood of the modern economy. Without continuous lending, economic activity gradually slows. Businesses invest less. Consumers spend less. Construction declines. Innovation becomes more cautious because less new purchasing power enters the system. Now imagine millions of borrowers repaying debt while very few new loans are being created. The money supply begins shrinking. Liquidity becomes scarce. Confidence weakens. Economic growth slows. This process is often invisible at first. Factories continue operating. Stores remain open. Financial markets may still appear healthy, but beneath the surface, the architecture is already changing. Banks approve fewer loans. Businesses postpone expansion. Households reduce borrowing. Investment becomes increasingly selective. Eventually, the visible economy begins reflecting the invisible monetary contraction. Most people believe recessions begin when companies fail. Architects know recessions often begin when credit creation slows, because modern economies are not powered by paper currency. They are powered by expanding and contracting credit. This explains why central banks pay such close attention to lending conditions, not because loans are merely financial products, but because loans determine how much money continues flowing through the economy. Money creation is therefore not a single event. It is an ongoing cycle. Creation, circulation, repayment, destruction, then creation begins again. Understanding that cycle transforms how we see economic growth, because economies do not simply produce more goods, they continuously adjust the amount of purchasing power supporting those goods, and that adjustment begins inside commercial banks. At this point, a deeper question begins to emerge. If commercial banks can create money, can they create unlimited money? Most people assume the answer is yes. Architects know the answer is far more complicated. Banks do not create money without limits. They create money within constraints. The first constraint is capital.
Every bank must maintain sufficient capital to absorb potential losses. The larger its lending activity, the more capital it must support. The second constraint is liquidity. A bank may create deposits through lending, but it must still settle payments with other banks every single day. Liquidity keeps the entire banking system functioning. The third constraint is regulation. Central banks and financial regulators establish rules designed to prevent excessive risk. Reserve requirements, capital adequacy, stress testing, risk management. Together, these mechanisms determine how aggressively banks can expand credit. And there is one final constraint, perhaps the most important of all: demand. Banks cannot create loans without borrowers. Every new dollar begins with someone willing to borrow and someone else willing to lend. Confidence connects both sides. When confidence is high, businesses invest, families purchase homes, entrepreneurs build companies, banks expand credit, money grows. When confidence disappears, everything changes. Businesses delay expansion. Consumers postpone purchases. Investors become cautious. Banks tighten lending standards. Credit slows. Money creation slows with it. Notice what is actually driving the system. Not paper, not vaults, not printing presses. Confidence. Confidence determines borrowing. Borrowing determines credit. Credit determines money creation. Money creation influences economic activity. Economic activity reinforces confidence. The entire system becomes a self-reinforcing cycle. This explains why financial crises spread so quickly. The first thing to disappear is rarely money. It is confidence. And once confidence weakens, credit begins shrinking. Once credit shrinks, economic activity follows. Most people believe money drives the economy. Architects know confidence drives money, and money amplifies confidence. This invisible relationship explains why modern banking is not simply a financial industry. It is the circulatory system of the entire economy. Every business expansion, every new factory, every commercial building, every startup, every mortgage, every infrastructure project begins with one invisible decision: a bank deciding whether new purchasing power should exist. That decision quietly shapes the future long before society ever notices.
By now, one truth should be becoming clear. Modern banks are not vaults. They are engines. Not engines that manufacture products, but engines that manufacture purchasing power. Every economy depends on production. Every producer depends on capital. And every unit of capital begins its journey somewhere, inside the banking system. This changes the way we think about economic growth. Most people imagine economies grow because people spend more. Architects know economies grow because productive credit expands. Credit allows businesses to build factories, purchase equipment, hire employees, develop technology, construct infrastructure, increase productivity. Without credit, economic growth would depend almost entirely on accumulated savings. Progress would become dramatically slower. Entire industries might take generations to emerge. Credit compresses time. It allows tomorrow's productivity to begin today. That is why responsible lending can accelerate prosperity. But the same mechanism can also amplify instability. When credit finances productive assets, future output increases. Society becomes wealthier. When credit finances speculation, asset prices rise faster than productivity. The economy becomes increasingly fragile. Notice the distinction. Credit itself is not good. Credit itself is not bad. Its impact depends entirely on where it flows. Credit directed toward innovation creates future income. Credit directed toward consumption creates temporary demand. Credit directed toward speculation creates temporary prices. Architects, therefore, ask a different question. Not how much credit is being created, but where is the credit going? Because every dollar of newly created credit shapes tomorrow's economy. Every lending decision becomes an allocation of future resources. Every loan quietly determines which industries expand, which technologies emerge, which businesses survive, and which ideas never leave the drawing board. Banks, therefore, do something far greater than creating money. They allocate possibility. They decide which parts of the economy receive the purchasing power needed to grow. Most people see a loan. Architects see capital allocation. Most people see interest rates. Architects see incentive structures. Most people see banks. Architects see one of the invisible operating systems supporting modern civilization. Because money is never created without consequence. Every new dollar changes incentives. Every new loan changes opportunity. Every expansion of credit reshapes the economic landscape long before the public notices. The invisible factory never sleeps. Every business day, thousands of lending decisions quietly redesign the future, one balance sheet at a time.
The greatest misunderstanding about banks is believing they simply store money. They do not. Modern banks create purchasing power, allocate capital, and influence the direction of economic growth. Understanding this changes everything. You stop seeing loans as isolated financial products. You begin seeing them as the mechanism through which the future is financed. Every growing industry, every expanding city, every new technology, every successful business, at some point, was supported by credit. That does not mean every loan creates prosperity. Poor capital allocation creates bubbles. Excessive speculation creates instability. Irresponsible lending creates crises. The mechanism remains the same, only the destination changes. This is why architects never ask, who has the most money? They ask, where is new credit flowing? Because today's credit often becomes tomorrow's innovation, tomorrow's infrastructure, tomorrow's productivity, and tomorrow's wealth. Most people follow money. Architects follow credit, because credit is where money begins. Most people study balance sheets. Architects study the invisible incentives behind them. Most people react to economic change. Architects recognize the change while it is still being financed. That is the difference between observing the economy and understanding its architecture. Because wealth is rarely created by chance. It is created by recognizing the invisible systems that shape opportunity before those opportunities become visible to everyone else. This is ASUTSEN, architecting wealth, automating future.